the extra immigration helping to cool nominal wage pressures. I mean, it really has been a pretty extraordinary experience. But I do think, given prices are high, inflation's a political issue, I think it's going to be a little while before they really declare victory.
They've had a supply-side solution. Let's see if we get a demand-side problem as we go through things further this year. The labour market's the one for me. It's the one for many others too. Unemployment right now is above where they think it will be year-end. I'd be very intrigued to know what their forecast is going to be when we get an update in September. And for that matter, we've got 2 more payrolls reports. I want to know where unemployment actually is by the time we get to September, where jobless claims are, and whether we have a very different conversation about the labour market in that news conference in a couple of months.
Which is the reason why we keep saying this, that really what's going to happen between now and September is not whether or not they're going to cut rates, it's what kind of rate cut it's going to be and what the path is going forward. Arguably, the work has been done on the front end. Now the question goes to the long end, and the question goes to, frankly, risk assets and whether they continue to rally in the face of some sort of rate cut.
By the time we get there, we'll be talking about the election in November a little bit more as well. So you've got all of that still to come. Jonathan, it's good to see you. Thank you, sir. Jonathan Pingle there of UBS. Coming up very shortly, a Bank of England rate decision is about 4 minutes away, and we've got an all-star, rock star lineup for you over the next 60 minutes or so. Coming up next, Sri Kochagambadam of Aberdeen, Jim Zelter of Apollo, the Barclays CEO, CS Venkatakrishnan, and former Kansas City Fed President Esther George, the second hour of Bloomberg Surveillance. Up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It'll be easy, but at least there's a theory of change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
think the Fed feels that it's in a sweet spot right now, that the data is moving in its direction.
In September, it's going to happen unless the economic outlook changes materially.
To invoke the Olympics now, this is a Fed that really wants to stick the landing.
Soft landings are not easy. They look good on paper, but getting there can be a hard path.
If it in fact happens, the Fed can bring down rates a fair amount, and the markets will continue to appreciate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Well, we have got a rate cut on Threadneedle Street at the Bank of England. The previous rate was 5.25. It's 5% now. It's a 25 basis point cut. We've got some work to do. From New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now. Economists in our survey were looking for it. They were looking for a split decision as well. And a split decision, Lisa, is what we got from the Bank of England's MPC.
Yeah, what you can see right now is Green, Haskell, Mann, and Pill all voting to hold rates. The other five voting to cut rates at a time when inflation has eased somewhat substantially. Talking about headline inflation around 2% right now, even though core CPI came in at 3.5% in June. They said that they see inflation at 1.7% in the third quarter of 2026 and 1.5% in the third quarter of 2027. Hello, Jeff Rosenberg, talking about the potential of disinflation reemerging as a bigger risk.
A quarter-point cut over at the Bank of England. The vote 5-4. Governor Bailey cautious on cutting too quickly or by too much. The decision they characterize as finely balanced, a finely balanced decision from the Bank of England. Let's get into this a little bit more. Let's turn to the story in sterling and get to cable. The pound right now, a little bit lower, down 0.7%, 127.66. I want to cross over to Lizzie Burden outside the Bank of England to get a breakdown on what's been happening from the Bank of England. Lizzie, over to you.
Well, John, they said that we were going to get a rate cut this summer. The sun's out in force, and here we are, the first cut in 4 years' time for the Bank of England. It was what was expected, although it really was on a knife edge because, yes, headline inflation is back at 2%, but services inflation came in hotter than expected last time, hence the cautious tone around this decision, particularly from the Governor, Andrew Bailey, as you say. It's reflected in the vote split as well. 5-4, it was what economists expected. But then if you also look to the guidance, no specific guidance on when the next cut is coming, where rates are going to settle. And that's the tone that we can expect to continue in the press conference. It's a bit reminiscent of Christine Lagarde at the last ECB meeting, really trying to keep the door open for the path ahead.
Lizzie, you mentioned the ECB. Some people have criticised the decision to reduce interest rates over at the ECB a couple of months ago. SocGen called it data independent. How data dependent is this call? What's the data behind this move this morning?
Look, John, if they hadn't cut rates today, when inflation at the headline level is back at 2%, it would have raised a real credibility issue for the Bank of England. If you look beneath the hood, services inflation, as I say, did come in hotter than expected last time, but look underneath that, and a lot of it is about the Taylor Swift effect, actually, on hotel prices. All the sorts of things that are really volatile that the Bank of England itself acknowledged last meeting that it's aware of, and if you strip them out, actually, services inflation is on the way down. So you can understand why they've cut rates today.
Looking right now at 10-year yields in the UK, and you can see remarkably lower. To me, this was a fascinating statement, Lizzie, because it didn't just talk about cutting rates in the near term and a finely balanced risk now. It talked about essentially disinflation that continues into 2025, into 2026 and beyond. It raises this question about whether the long-term neutral rate, at least in the United Kingdom, is basically right back where it was pre-pandemic. Can you just talk a little bit about this idea that, yes, inflation will hit 2.7% before retreating, but that it will go beneath 2% in the years following?
Well, of course, these forecasts are based on the market curve, but that market curve has been fluctuating, moving a lot over the past 15 days. You've had traders ramping up their bets on this cut, really on the basis of thin air. No new data, no new speeches. But look, the fact that they're seeing that down the line tells you a bit about where they see rates coming ahead. It suggests that, yes, we have got more cuts coming in the pipeline.
Lizzie, great work as always. We'll catch up with you a little bit later. Lizzie Burden there of Bloomberg outside the Bank of England. The Bank of England rate decision, a quarter-point cut to 5% from 5.25. A finely balanced decision for some voting for an interest rate cut, according to the Bank of England. The vote, 5-4. Governor Bailey, cautious on cutting too quickly or by too much. So what have we seen from both the ECB and the BOE? We've seen an interest rate cut, but I have to say, it's sort of like a nervous step forward, or rather a step back, however way you want to frame it. You put it together with the Federal Reserve, they're moving very, very slowly. And I think that's the common theme here across all three central banks, the ECB, the BOE, the Federal Reserve. It's the pace at what they're moving here. They're moving slowly. Why? Do they think they haven't slayed the inflation beast? Are they still worried about inflation reappearing? Is that the conversation we should be having right now? This is what Neil Dutter said of Renmark yesterday about the Federal Reserve. What's the argument to wait? If the argument to wait is we're still worried about inflation, then you need to present an argument that inflation can reaccelerate. What's the argument for that?
The argument to wait is simply that they're in a black room feeling their way around and trying to understand the new paradigm, which is why I thought it was so interesting. The Bank of England sees really much lower than 2% rates of inflation in 2026 and 2027. This really does set up the question of what is the neutral rate. And that really is what I want to hear from the Fed this month, because ultimately the ECB, Bank of England, and the U.S. all facing off with this really existential question. Are we in a new regime of inflation post-pandemic that requires a very different kind of caution for central bankers before cutting rates? That question has not been answered, and I would argue that is the question causing a lot of caution underpinning some of these decisions.
But what is the ultimate destination? The scores elsewhere look like this. We've got cable down to about 127.62. That's the pound against the US dollar. That currency pair negative by 0.7%. In the British bond market, the gilt market, bonds are rallying. Yields are lower by 7 basis points at the front end on a 2-year. On a 10-year, we're down about 5 basis points at the moment. For more on this decision, I'm pleased to say that joining us right now is Sri Kochagopadan of Aberdeen. Sri, let's get into the decision first. The split decision 5-4. What do you make of what you've seen so far?
I think this was very much in line with our expectations, actually. We had been flagging it's a close call. And the nature of the split, the 5-4 vote, and the people who voted in favor of a cut, you know, these are the names that we were looking to as well. And I think what we're going to see in the press conference later is that we'll see, again, this continued cautiousness that you've just referenced, actually, that we are going to see this. Yes, we've had a cut. It's going to be more of a hawkish cut. And that will be the signal for now, because as you say, really, across all of these central banks, it is the services inflation that's still remaining quite resilient. And it's this wage growth story, the services at 5.7% in the UK. This is above what the NPR had been expecting in the last June meeting that the Bank of England had published their NPR previously. So the services have overshot, while goods prices have offset that a bit and undershot recently. So really, it's, as you say, where it's a lot of the pandemic drivers that were mentioned yesterday by the Fed, these external drivers, they've all unwound now. It's really those domestic drivers and the labor market that's driving the story. So in the UK, we are seeing a mixed bag here, but some tentative signs of loosening in the labor market, with unemployment ticking higher. Vacancy to unemployment rate is at 6-year lows now. So this is all showing signs that maybe it is time to cut before we start to see some changes in inflation as we move into September, October, where you start to get the impact of the Ofgem price cap and some distortions there. Today did seem like the best time to implement a cut and then see. It'll be data dependent. I'm sure that will be a phrase we hear again.
I'm sure it will be on repeat with that news conference just around the corner with Governor Bailey. Sri, Lisa brought up the destination. Where is all of this heading? And for that kind of conversation, we need a bigger, deeper conversation, a debate, if you will, about the current environment and the regime we're going into. Have we broken out of that pre-pandemic regime of low growth, low inflation? And are we going to stabilize here at higher levels? And does that mean ultimately this Bank of England interest rate, when it comes down, will settle down at a different level than it otherwise would have? What are your thoughts on that with the team at the moment?
Yes, we are looking at, the pace of rate cuts. I mean, we are expecting, a bit of a pause and maybe another rate cut later this year. And this is all something that we'll look at today's meeting and the details to get a real steer of the pace from here. But I think longer term, are we in a new inflation paradigm? I mean, I think there are some, supply side issues in the UK economy, and really this labour market dynamic with higher wages, which are quite sticky. They are starting to turn down. But that is still a question mark for the Bank of England, I'm assuming. We do have a new government there, but we're not seeing any material impact on monetary policy from the policy that we're going to see from the government. We'll see a budget at the end of October from the new Chancellor, Rachel Reeves. But a lot of the measures that have been mentioned so far, they are longer term supply side boost to growth, which will be difficult to actually deliver. Considering the hole in the fiscal in the finances, government finances that have been discussed recently. So I think that again there'll be some relative stability there for the next year or so. No material changes from the fiscal side. There is a constraint there that has been flagged quite early on in terms of how much they can deliver in terms of a fiscal boost. So again, it just does look like on the whole, we are moving back to the sort of era that we were in pre-pandemic, but we do need to monitor, what is happening with labor force participation. We are seeing a normalization there in terms of some of the distortions in labor force participation, labor supply, and high demand relative to supply in the labor market there. So those distortions are unwinding. So we're quite optimistic that we can start to see the pace of easing gathering next year. So some cautious, tentative steps initially, but then once we get some clarity in terms of the labor market dynamics, global growth issues as well. The euro area growth was weaker. There is some concern that, how sustainable is the uptick in GDP in the UK at the moment. The demand side looks resilient for now, and some stability there. But as you say, was it the Taylor Swift effect? We've yet to see.
That effect seems to be everywhere over the last couple of years. Sri, thank you. Sri, Co-Governor there of Aberdeen on the latest Bank of England rate decision. Lisa, the first cut since the pandemic from the BOE.
Yeah, although cautious, and with a 5-4 split, as you mentioned, really interesting to see the longer-term inflation expectations coming down below 2%. There was one question you asked, which is, we're hearing a lot of caution from the Bank of England and the ECB. What's behind the caution? Yes, it is services-side inflation, but how much is it a currency differential as well? If they move too quickly ahead of the Federal Reserve and they weaken their currency, does that actually make their inflation problem worse and get them into a hole? I wonder how much that's, just in the back of people's minds as they make some of these decisions.
Just a programme note for you. That news conference with Governor Bailey starting in about 18 minutes' time. If you are in the United Kingdom, our colleagues over in London will pick up coverage for you and take you into that news conference. For everybody else, it's quite a lineup. The Barclays CEO, CS Venkatakrishnan, joining us in about 20 minutes' time. We're also catching up with the Apollo Pro president. We'll catch up with Jim Zelter in about 5 minutes. After that, the former Fed president, Esther George, on the Fed decision of yesterday. So that's your lineup for the next 45 minutes or so. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Qualcomm shares lower by 1 1/3% this morning. Its earnings yesterday fueled concerns that the phone market is recovering more slowly than investors had hoped. Qualcomm did project stronger sales and earnings, but said phone shipments are only rebounding gradually. The CEO said that they expect units to be flattish or up by single-digit percentages this year. Shell is up in the pre-market this morning, up by some 1.8%. The oil and gas giant reported profit and cash flow that beat expectations in the second quarter. Those results underpinning yet another resilient stretch for the British energy company. Net debt fell by more than $2 billion over the period. Steady crude prices also helped to offset weakness in other areas like refining and nat gas. Shell also confirmed another $3.5 billion share buyback. Israel says it confirmed the death of Hamas's second-in-command after striking a compound in Gaza 3 weeks ago. The IDF had previously said that it was all but certain that Mohammed Daif, the leader of Hamas's armed wing, had died in a strike in the city of Khan Yunis. Daif had been considered Israel's most wanted man for over 20 years and is alleged to have played a central role in planning the October 7th attacks. Hamas's overall leader remains at large in Gaza. And that's your brief, John.
Danny, thank you. And more from Danny in about 30 minutes' time. Up next on the program, the future of private credit.
Private credit is undergoing, I think, a real sea change. I think that this asset class is going to continue to grow, and it's going to go from direct lending, which has been into the middle market, to now asset-based finance.
That conversation up next. We'll catch up with Apollo after the commercial break. From New York, this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from New York City, welcome to the program. Equity futures on the S&P 500 higher as we kick off the month of August, up by 0.5%. Bond yields drifting up as well by 3 basis points after a 5-day rally. Over that period, yields dropping 25 basis points on a 10-year, just short of dropping into the threes, 4.06% on a 10-year right now. Under surveillance this morning, it's the future of private credit.
Private credit is undergoing, I think, a real sea change. You know, since the GFC, banks have continued to back out of lending money into the middle market. And so private investors and asset managers have really stepped into that void. I don't see that reversing. I think that this asset class is going to continue to grow, and it's going to go from direct lending, which has been into the middle market, to now asset-based finance.
So here's the latest this morning. Apollo Global's second quarter profit coming in just short of estimates, while assets under management and fee-related earnings rose. Apollo Asset Management co-president Jim Zauter writing this: we expect to see continued strong growth in private credit, including asset-backed finance, and expect to see continued demand to access this market, partnering with banks more than ever as companies look to finance themselves with long-term capital. Jim's with us around the table here in New York. Jim, good morning. It's good to see you.
Good morning. Good to see both of you again.
You've got a good story to tell, but before we get into that good story, just short of estimates here, what's held back profits in the last quarter?
Well, listen, I think the firm is really firing on all cylinders. It was a great number, record FRE performance, record deployment, record origination, and the flywheel